Good morning, friends, and good morning, my dear students. Today we are going to talk about repo and reverse repo rate, right? So yesterday's videos we were talking about CRR and SLR, how it operates and all that. Okay, but CRR and SLR is also a part of monetary policies, and we call it as a monetary tool which is available with RBA to manage inflation and economic situations or stimulate economic growth. Right. So the RBI is a regulator of Indian banking system and financial services. It uses various tools to manage economic growth and inflation. One of the tool which we have discussed on yesterday is CRR and SLR. And there are other three major tool which RBI has got to manage liquidity condition with the banking system. When they manage a liquidity system in the banking system, which automatically manage their inflations and economic growth, which is explained on yesterday. Okay, so now the one of the important liquidity management tool, what RBI is having it, we call it as open market operation, OMO, open market operation, right? This open market operation is nothing but borrowing and lending to the bank. That is called open market operation. Normally, RBI borrows money from the bank and also RBI lends money to the bank, right? So the process in which RBI borrows and lending is called open market operation. The basic question one should have that is why RBI borrows, why RBI lends money to bank, why RBI requires so much of money. The basic underlying principle is the RBI sees the banking system has got more money, right? So the RBI wanted to reduce the money available in the system. So what immediately they will do is they will ask RBI banker to give back the money back to RBI. So in the process, what will happen? Bank will have a lower or less money so that they cannot go aggressively on lending. The same way, whenever the banker is suffering for a liquidity or bankers don't have the money, RBI lend or infuse funds into the banking system, right? The important function of RBI is to manage liquidity system available with banking and financial sector, right? So in the process, what will happen is the banker, can go borrow from RBI or banker can lend money to RBI, right? So this is the process we call it as open market operation, right? The RBI lend money at a rate to the bank is called repo rate. RBI cannot lend just like that free of cost. Just take the money to you, right? The same way RBI cannot borrow money at a free of cost. So the RBI lend at a rate is called repo rate. Okay. RBI borrows money from the bank is called reverse repo rate, right? Please remember, repo means the rate at which RBI lends money to bankers. Reverse repo is the rate at which RBI borrows money from the banker. Okay. The borrowing and lending at a rate is called repo at reverse repo rate. Okay. Normally, repo rate is higher than the reverse repo. The reason is normally RBI borrows at a lower rate, lends at higher rate. The rate at which RBI lend, right, is called repo rate. The repo and reverse repo, it keeps changing it on a daily basis. It is not a common or a standard rate. We call it as a policy rate in RBI. So if you go through the RBI site, there are three rates which is defined in RBI site. One is repo rate, reverse repo rate. We call it as policy rate. There are reserve rates. What is reserve rate? Cash reserve ratio, statutory liquidity ratio. That is 3% on cash reserve ratio. SLR is 18%. Normally reserves rates are standard or it will be remain same for at least 2 to 3 months time, and RBI won't change frequently. But repo and reverse repo rate, which changes, that we call it as policy rate, that changes every day. The reason is the repo and reverse repo, it is purely depends on demand and money supply with the banking system, right? Then other rate is deposit and lending rate. That also won't change much. But repo and reverse repo rate, which changes very often and very frequently. The reason is the demand and supply requirement of a bank is changes on every day, right? Most of the call money market, right, operates based on the repo and reverse repo rate. And call money has got a various product like call money, it is the overnight borrowing and lending, and term money, all these things which is there, that we can see it in the next video or the subsequent videos. But today, the repo and reverse repo, the rate at which RBI lends and RBI borrows. Normally, the repo rate is the rate at which RBI lends. Reverse repo, the rate at which RBI borrows. Normally, the lending rate is higher than the borrowing rate. So the repo rate is higher than the reverse repo rate. Okay. So the reverse repo and repo rate is very important rate one should see on every day. When the rates increases, that means the liquidity is tightened or hardened. The reason is the repo and reverse repo is an indication whether the bank has got sufficient money or not. If the rate is reduced, that means the banker has got sufficient balances or sufficient money in the banking system, right? So one should see whether everything is order in banking system, or what is the current interest rate prevailing in the market. So please go and watch in rbi.org the repo and reverse repo for last 2 months or 3 months, whether it is in the increasing trend or in the decreasing trend. As a banker, as a banking aspirant, as a financial services executive, one should know what is the repo rate and reverse repo rate mostly on, or at least I can say that it's on a daily basis. We should see that what is happening on that, whether the rates are increasing it. Suppose if RBI started lending at higher rate, that means they are discouraging the bankers to borrow, right? So the repo and reverse repo is very critical for the banking system to borrow and lend money from the RBI, right? This will also gives an indication whether the interest rate scenario is moving up or moving down, right? With that, we will close on that, and tomorrow we will also see that the other monetary policy tools like market stabilization facilities and all that. So how it will have an impact on Indian economy and inflations, right? Thank you so much.